John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hey there, this is John Ulzheimer. I am a consumer credit expert. I've got almost 30 years of experience in the credit industry. Spent some time at FICO, which is the company behind the FICO credit scoring system, and Equifax, which is one of the 3 generally recognized credit reporting agencies in the US. So today I'm going to discuss another type of score with which you need to become familiar, the insurance credit score. So you've probably heard, or if you follow credit, you're probably aware that the use of credit reports for insurance underwriting is legal. It is a permitted use of credit reports in the Fair Credit Reporting Act, meaning it specifically says in the Fair Credit Reporting Act that it's permissible to pull a credit report for insurance underwriting. Insurance companies, as do almost every lender in this country, uses a form of a score or multiple scores to determine whether or not they want to do business with you for homeowners and auto insurance and other types of insurance coverage, and under what terms. And specifically in the insurance world, that means what is your premium going to be, meaning what is your cost going to be for you to have an insurance policy. One of the clarifications that has to be made up front is that a credit score, meaning a score used by, say, a bank or a credit union or a credit card issuer, is not the same as an insurance credit score. So when you hear people talk about, insurance companies use credit scores, that's true, but there is definitely a distinction between the type of credit score that's used by an insurance company and a credit score that's used by a lender. One is used to predict the likelihood of you making payments on a loan or a credit card, and the other is used to predict the likelihood of whether or not you're going to be a profitable insurance customer or the likelihood of you filing a claim, which obviously in the insurance world, people who file a lot of claims are not profitable. Insurance companies want to avoid them. So it's a different type of score. Where there is similarity is the companies that build insurance credit scores. FICO builds insurance credit scores. FICO builds credit scores used by banks. We all know that. If you hear people refer to, well, my FICO insurance score is this, that is a correct representation. There are other types of scores that are also used in the insurance world. One is called the CLUE score, or the ATTRACT score, the ATTRACT score. And ATTRACT, believe it or not, ATTRACT was actually created by a company called ChoicePoint, which was Equifax's spinoff of their insurance services division, which was then acquired by LexisNexis. And so now LexisNexis actually owns the ATTRACT score, and they also own what's called the CLUE, which you heard me refer to incorrectly a minute ago, the CLUE database, the Comprehensive Loss Underwriting Exchange database, which is basically just a gigantic database filled with insurance claims that have been filed over the past 7 years. So LexisNexis really is kind of like the quote-unquote, quasi-credit bureau in the insurance world. They have the database, the CLUE database, and they have the scores, the ATTRACT scores. And so there's a homeowner's ATTRACT, and then there is an auto version of the ATTRACT score. So when you apply for some sort of insurance, then it is not uncommon for the insurance provider to pull a credit report and calculate one of these scores, either a FICO insurance score or an ATTRACT score. And then, of course, that score can be used as the basis for the decision as to whether or not they want to do business with you. You can go and get all this stuff. LexisNexis is a consumer reporting agency, and the CLUE report is a consumer report, much like a report you get from Equifax is a consumer report, even though we call them credit reports. So you can certainly pull your CLUE reports. If you haven't filed an insurance claim over the past 7 years of any variety, then you're not going to have a report because the only thing that goes on those reports would be records of you filing an insurance claim over the past 7 years. So if you don't have a report, it's actually a good thing, because that means that you're not one of these kind of habitual or serial filers of insurance claims, which would make you a low-risk insurance customer versus someone who's got a lot of those claims, which would then make you a high-risk insurance customer and therefore would be more problematic. The reports that are used to calculate the insurance score is the same report that's used to calculate a credit score. So it's the credit report that is pulled from one of the 3 credit bureaus, which is really, that's where kind of the disconnect or the anger begins, because people are like, wait a minute, why does my credit report have anything to do with my insurance? And it has been empirically proven repeatedly, even though people don't want to listen to this, that there is a relationship between how you manage your credit and what kind of an insurance customer you're going to be. So the science doesn't lie, just people have a hard time wrapping their head around why a credit report would be important for insurance underwriting. So hopefully that helps answer some questions about insurance scores. If you have any questions about that, drop them in the section below and we'll get to them. Thanks a lot for watching and have a great rest of your day. We'll talk again soon.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.